we think this is a really timely point to do a review of what's happened. It's been an extremely volatile first half, as you know. Very challenging period for all investors, emotionally and financially. So a lot of clients are obviously wondering, what are we doing to manage your portfolios in these turbulent times? What do we see going forward? To address those questions, we're going to go through a myriad of different topics today that will hopefully give you an idea of how we've been managing your money and how we intend to manage it going forward. This is just our standard disclaimer. Basically removes John from any liability that he might incur from anything that any of us say on his behalf today. Just wanted to give an update on the team. On the associate side, there might be a couple new people that you've seen, a couple new faces. We've managed to bring on some excellent new associates in Vincent Zhang and Kadeem Sanji. So they'll be helping myself, Aaron, and John with your financial plans, with keeping your accounts up to date, with reviewing your portfolios with you. Everybody's aware of our portfolio management team. We'll be introducing a little bit later some interesting new models that Elvis and Zaw, our analysts, have put together for us for a growth equity portfolio. Aaron Cooper is also one of our senior associates, and of course everybody's aware of our excellent admin team in Christina Schild and Neve Cosgrove, and Mari Kionhan will be coming back in the fall after her mat leave's over. So let's talk a little bit about volatility and why I think Usain Bolt is a good barometer. So when things get volatile in global equity markets, one of the things you have to consider is a benchmark for your portfolio prior to making any sort of rash changes to your strategy. So a benchmark gives you something to compare what you're doing or how you've done against. So stock markets, as we know, they often move very quickly. So if you change your strategy after the markets have moved, it's generally akin to the old cliche of closing the barn door after the horse has already escaped. Doesn't do you a lot of good. So let me explain what I mean by the Usain Bolt analogy here. So what if I told you I was a really fast runner? Obviously you'd think that, but you might believe me if you had nothing else to compare it to. So what if I said, let's compare my speed to, say, Usain Bolt? I might be only half as fast as Usain Bolt. I may only be 20% of the speed of a cheetah. Maybe not 20, but I'm exaggerating. But having a benchmark allows you to do comparisons and thus judge the efficacy of your strategy. In other words, we have to do the same thing. We have to benchmark our portfolio, especially in times of volatility, to see how we've done. And those managed portfolios need to be benchmarked against appropriate benchmarks. So generally, the clients and ourselves that we manage money for will fall into three categories for your long-term money, not including cash. Cash isn't our benchmark. But you're either going to be investing with us as a balanced investor, a balanced growth investor, or a growth investor. So I'm going to look at these three different asset mixes for you and show you the volatility that you've experienced and that you can expect with each of these, and we can discuss them. So we're going to go over how to set an appropriate benchmark. So what's a good comparison? How is your portfolio going to perform going forward? So the risk you can expect, the return you can expect, and whether or not you're comfortable with that volatility. Okay. So looking at these asset allocation buckets that we have and trying to set an appropriate benchmark for yourself. You see, there's three major classes that we can benchmark and create buckets for. So we got a balanced investor, which is going to be 40% stocks, a balanced growth investor, who's going to be 60% stocks, and a growth investor who's going to be 80% stocks. So if a cheetah is the fastest land animal from our last slide, and I'm only 20% as fast as a cheetah, maybe not, but if you think of the cheetah as the fastest land animal, then a portfolio that's 100% stocks is equivalent to you going all in on the economy for your portfolio. So a good proxy for the equity markets, and a simple one that you hear about all the time, would be the S&P 500. So this index holds 500 of the largest companies in the world. So essentially, if the economy is doing poorly, you can expect that those profits of those 500 companies are also going to do poorly. So to invest simply in those 500 companies in the S&P 500, you could buy an ETF, an exchange traded fund, a little basket of all of those companies. So a good comparison to use there might be Vanguard's S&P 500 ETF, which is VOO. So this is going to hold companies like Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson. So then you would compare the relative returns of your portfolio, of your asset mix, to an all stock portfolio. So how fast you run compared to the cheetah. So remember, balanced portfolios are 40% stocks, balanced growth are 60% stocks, growth are 80% stocks. So how have these portfolios done, if we're looking in the rearview mirror, compared to the overall market? So as you would expect, the drop corresponds roughly to the amount of stock exposure that you have. So in other words, balanced investors, 40% stocks. We would expect them to drop 40% of the market drop. So what happened so far this year? A balanced portfolio is down 15%. The S&P 500 ETF to the end of June is down 20%. So that means the balanced investor, who's only 40% stocks, captured almost 75% of the risk of the stock markets. So this is very similar to a balanced growth investor and a growth portfolio. So why? Shouldn't the volatility be less? In other words, if I've got 40% stocks and the market's dropped 20, I should only be down 8%. What happened? So this year, there was the unfortunate double whammy of stocks and bonds being negative. So if you look at the slide, a balanced portfolio had a very similar drawdown to someone who had 60% stocks in a balanced growth portfolio. So in a period of time where interest rates were going up and the expectations were that rates were going to rise, the bond market pulled back as well as the stock market. So instead of using just the equity market then as a benchmark, perhaps we should look at a benchmark that's a portfolio that uses purely passive indexes. So in other words, one solution, one index that incorporates everything from US, Canadian, international stocks, including bonds. So a good one here is the Vanguard Balanced ETF Portfolio Fund. So it consists of 60% stocks, so 25 US, 18 Canada, 16% emerging market, and the remainder is in bonds. So this balanced mix, as you can see in the upper right-hand corner, was down 14.33% year to date. So comparison, our largest portfolios, I've shown them on the bottom, the largest one that we manage is our balanced growth pension portfolio. So this is 60+% stocks, and there's over 160 million in assets in management. So you compare that to a passive portfolio like the Vanguard Balanced ETF, that'll give you an apples to apples comparison. And we see that the Vanguard Balanced portfolio is down 14.33. We were only down 12.5. So we outperformed a purely passive benchmark. So comparing it to the US markets, which were down 20%. So you see the Vanguard 500 index investor was down 20%. So just if you bought those top 500 stocks, our portfolio was down 12.59, our largest balanced portfolio. So we captured only 60% of the volatility, which is exactly where you expect to be. So keeping it simple, if you think about, say, our Pursuit portfolio, which is our growth portfolio, it's 80% stocks, okay? Normally, our Pursuit portfolio targets 80% stocks. It should give you 80% of the upside and 80% of the downside. But you can see actually our growth portfolio did better than our balanced growth portfolio. How can that be? The outperformance of the stock holdings we held. So really good stock picking by our senior portfolio manager, Elvis Picardo, and our associate portfolio manager, Zatun. So those stocks did better than the broad market, which led us to outperform our benchmark by a very significant margin. Also, they had less bonds. Bonds did very poorly. So going forward, what would you expect? You're going to have to think about your portfolio in a very simplistic way. A balanced investor who has 40% stock exposure should get 40% of the upside and 40% of the downside of the markets. Okay. If you look up in the top right-hand corner of the slide where you see it says maximum drawdown, if you're a growth portfolio, you have to expect that you're going to get, 80% or more of the variability of the stock market. So stocks drop 20, you have to allow yourself to be down, anywhere from 16 to 18%. If you can't handle that level of drawdown, then you have to consider reducing the stock exposure you have. But that comes with a price, especially after markets have gone down. If you reduce your equity exposure now, you'll never get the upside when the markets invariably recover. So take your stock exposure in your portfolio, be it balanced growth or growth, so 40, 60, or 80% stock exposure, and look at the overall market. If I'm a balanced investor and the stock market goes up 2% today, I've got 40% stocks. I think I'm going to go up 0.8 to 1%. When you see the headlines and they say the Dow Jones is down 500 points, you may not even know what that means. But look at the percentage drops or gains that you see in the overall market and remind yourself, even as a pension investor, the stock market was down 20% at the end of June. Our balanced growth investors were only down 12.5. So significantly less variability, and that will give you the solace to hold on to your current strategy through market turmoil. So in other words, if we get 10% more of a pullback from here and you're a balanced growth investor, you might only see a 5 to 6% drop from this point, and we would continue to rebalance your portfolio. So one of the last thing I wanted to bring up then was obviously reducing risk, selling stocks when they're down after the horse has already left the barn is a terrible strategy. Okay, so if you've gone to cash or you're thinking about going to cash at this point, if you didn't need all that money tomorrow, that is the absolute worst thing you can do. We do not manage portfolios that can go to zero. If our portfolios go to zero, it's a zombie apocalypse. You need a 12 gauge and a fishing rod. Okay, as we've seen, if you think the biggest 500 companies in North America are going to go to zero, you should be building a bunker and stocking it with a lot of salt tablets and beef jerky. Otherwise, you're just looking at how much variability you can handle. So the wrong thing to do when markets are this volatile is to go to cash. Potentially the right thing to do is be comfortable knowing that if you're 40% stock exposure, you're going to get 40% of the risk of the market. 60%, you're going to get 60% of the gains and losses. But with markets down, we thought it would be perfect timing to actually go the other way, to offer an all-stock portfolio. So I really like prime rib. I don't like paying full price for my AAA prime rib, but if it goes on sale and I see it goes on sale, I buy more. To the extent that they might think I'm on a keto diet when I go into my local thrifties. Same thing with good companies. If I liked a company at $1 and now somehow this company is trading for 50 cents, I should like it even more. So the top picks of our two senior analysts, Elvis Picardo and Zotun, we've added to a single stock exposure with some alternative exposure to real estate instead of bonds. So these are our portfolio management team's top stocks. They'll be actively managed. You have to have a growth, in other words, 80% or more, or high growth investment policy. This can be done by the account. We think this is a really good way to hold a TFSA. Now that TFSAs are $80,000 plus, in many cases, we're seeing them up to 125 grand. This is a place where you might want to hold some of these really great large cap companies that are trading at a discount. You have to think about holding them for at least 3 years. You don't have to hold them that long, but that will help you ride out the variability. And it has to be suitable for somebody that doesn't necessarily want income. In a TFSA, it's great. You would just harvest any growth in a year that you made it. So if you're retired and it makes money, you could harvest the growth in those years where it makes money. This is growth oriented. So again, it will give you all the up and all the down of the stock market. I think really good strategy for a TFSA, maybe a smaller locked-in account or a non-registered portfolio that you don't provide income from. Okay, so without further ado, we'll pass it on to Elvis here.
Thank you, Robert.
You're welcome.
Hello, everyone. Good to see all of you virtually. And thanks for joining us on this webinar. So the material in my presentation is from the first half review and second half outlook report that was posted to our website over the weekend. And all these slides, most of these slides are from the presentation, from that report. So if 2021 was the year that everything went up, 2022 so far has been the year when everything has gone down. Nothing seems to be working. The hardest hit investments, and fortunately we don't own any of these, have been the ones that are the most speculative, as you can see from the chart on the left. Bitcoin and crypto, SPACs. So SPACs are basically a glorified term for shell companies that raise money and then go out and buy a business instead of it being the other way around. They did really poorly in the last 6 months. Cathy Wood's ARK fund. Now, this fund has become the poster child for the tech boom and bust for the past couple of years. All of these are down 70% or more. But some investments did better than others, like the TSX, which on a relative basis outperformed the S&P 500 by almost 10 percentage points, which is a huge, huge margin, as you can see in the right chart, in the first half. So the TSX was down about 11%. The S&P was down about 20.6. So that's a 10% differential in favor of the TSX. Now that margin had widened to a 17-year high of 13 percentage points, but right now it's down to about half of that, about 7%. So the TSX is still beating the S&P 500 by a big margin. So what else did well? Commodities did well, especially after the Russian invasion of Ukraine. But since then, they've lost a lot of their gains. Energy has been outstanding, and we all know that from the prices we pay at the pump. Gold also proved to be a much better store of value than crypto. Gold was only down 1.3% in the first half in US dollar terms, but because the USD was so strong, gold actually appreciated more than 7% in euro terms. So a few things did well, most things did poorly. The main reason for the broad decline in most investments was because of something that investors have not experienced for decades. And I'm referring here to inflation. Inflation has also been made worse by the abrupt appearance of a wildcard event, which was the Russian invasion of Ukraine in February. Now, this complicated the investment environment just as we were putting the pandemic behind us. Things were coming back to normal or trying to, and then the invasion happened. On top of that, we also have, or rather I should say, because of surging inflation, we now have the Bank of Canada and the US Federal Reserve raising interest rates at the fastest pace in decades. And why is this? Because they are well behind the curve in terms of controlling inflation. But as my presentation will show you, it's not all doom and gloom. After the first half correction, we are actually seeing a lot of good buying opportunities. And if you have a 3 to 5 year horizon, you should see some pretty good returns. So the TSX was holding up very well right until May. And then in June, it fell about 9%. And this was because concerns about recession intensified. The standout group on the TSX so far has been the energy sector, which had a return of 26% in the first half, as you can see on the left chart. In 2021, it was the best performing sector as well, with a return of almost 50%. The only other group to have a positive return in the first half of 2022 was the utility sector, which managed a return of about 1.3% purely because of its high dividend yield. The other sectors that held up a little bit were communication services and consumer staples. Both were down about 1%, which when you consider the TSX was down about 11% is a pretty good showing. Now, utilities, communication services, consumer staples, these are all defensive sectors. They're considered defensive because they tend to go down less than the market when it falls. And when the market rebounds, they also don't do as well. But I think investors are happy to trade off that upside for the limited downside that these groups give you. And we have quite a few of these in our stock buckets. Coming back to the TSX, the financial group fell 11% in the first half. And by June 30th, all the big five banks were in a bear market. They have recovered a little bit since then, but they're still down quite a bit for the year. If you look at the chart on the right, this is a stock chart for Shopify. And in terms of the worst performance for the year, unfortunately, Shopify gets a wooden spoon. It lost 77% of its value in the first half. Now, unfortunately, in Canada, companies sometimes get afflicted by what I call the Icarus syndrome, which is a mythical Greek figure who crashed and burned after flying too close to the sun. So names like Valiant Pharma, BlackBerry, Nortel, they all occupy this. They all have this unfortunate distinction. They were all number one in the Canadian marketplace at one point in time, but subsequently, most of those gains evaporated. Now, I'm not suggesting that Shopify will follow the same downward path, but its trajectory over the past 2 years is very symbolic of what's happened to many tech companies, many tech high flyers in Canada and in the US. On to the next slide. So how did our portfolios perform in this challenging environment? They actually did quite well on a relative basis. Our pension model outperformed ETFs, balanced ETFs like VBAL and ZBAL, which are two of the biggest balanced ETFs in Canada, outperformed significantly in the first half by about 2 percentage points. Our dividend model did even better, down only 10% to June 30th. All the outperformance was on account of our stock picks, names like Pembina, Loblaw, Nutrien, Hydro One. So we have 18 stocks in our top picks bucket. There's 11 Canadian stocks, 7 US. And so far, they are outperforming the benchmarks by about 8 percentage points on average. So if you do the math, these stocks account for roughly 25% of the pension portfolio, and 25 times 8%. So that's a 2 percentage point difference. So almost all the outperformance has come from the stock picks. I also wanted to briefly touch upon our Canadian dividend model, which is our second biggest by assets. This model generates more than 4% in tax-efficient income. So if you have non-registered money, it's a great choice for that cash. Now, given how challenging the first half was, we were pretty busy. We have already rebalanced most client portfolios at least 3 times in the first 6 months of the year. In January, things looked very different. Everyone thought the global economy was on track. COVID was becoming less of a factor. Things were growing. People were going out. So the global economy was supposed to do quite well. And as a result, we boosted exposure to the energy and financial sectors. But by the second quarter, things started falling apart. So in March, we rebalanced portfolios to deploy your contributions to RRSPs and TFSAs. In May, we took profits in some stocks and we bought others that were beaten down quite a bit. The point is, we are not sitting still. We are rebalancing proactively to capitalize on market volatility, but at the same time, we are trying to mitigate risk as well. And like I've said before, your portfolios consist of funds managed by the best managers. They contain top-notch ETFs and a lot of blue chips. We don't hold speculative stuff or stuff that's the flavor of the month. On the equity side, we have businesses that you can virtually hold forever. Manulife, Loblaw, Berkshire, Disney. Disney in particular, I think it's got tremendous upside. It's trading at less than $100. That's down almost 50% from its high last year. But it's got such a unique business, such a strong brand, and a fantastic streaming business. It's expected to beat Netflix in terms of total users by 2024 or 2025. So what's not to like? To me, that's a fantastic stock. It's one that we can virtually hold forever. And also on the fixed income side, we have a Steadfast fund, which is extremely well diversified. And we also have another pool managed by TD Asset Management, which is one of the biggest fixed income managers in Canada. So the point is, this overall your portfolio is extremely high quality, and they will be able to ride out this market gyrations, this volatility much better than a speculative or a lower quality portfolio. On to the next slide. I know the Platinum Growth Fund has been an underperformer, but there's a reason for it. And before I discuss that fund, I just want to give you a quick overview of what are called factors, which are essentially attributes that divide stocks into two basic categories, growth and value. You can also divide stocks by other factors like market cap, for instance, small cap, large cap, mid cap, and there are some other factors like momentum and quality as well. But for now, let's focus on the two basic categories of growth and value. So growth stocks, as the name implies, have very high growth rates of revenue, and they may or may not be profitable because people are willing to forsake profits in the expectation of high revenues and profits down the road. Growth stocks also trade at much higher valuations than value stocks, which have much slower rates of growth. Now, one sector that is synonymous with growth is the technology or tech sector. And over the past decade, the biggest tech names like Apple, Amazon, Google, Facebook, or Meta as it's now called, Microsoft, they all managed to grow at a phenomenal pace despite their huge size. Last year, Apple reached almost $3 trillion in market value, and Google and Amazon were close to $2 trillion. Now, for context, Canada's entire market, all our banks, all our tech stocks, all our energy names, everything, it's worth about $3 trillion. So Apple, a single company, was equal to the entire Canadian market, which is in the top 10 in the world. So something's not quite right here. Anyway, this growth trend accelerated during the pandemic, and many other tech names went along for the ride, especially those that benefited from lockdowns and the work from home phenomenon. So the classic example was Netflix, because people were staying home and streaming all the time, and Zoom. So these two companies were prime examples of the pandemic boom. But from November 2020, something happened. We got news that Pfizer and Moderna had developed successful vaccines against COVID. Oh yes, and Trump lost the election too in that month. But that apart, from November 2020, tech started losing steam, and we began seeing a massive rotation into value. This rotation was amplified in the first half of 2022. In November of 2021, the Nasdaq peaked, and at one point last month, it was down 30%. That's a huge drop in a 6-month period, something extremely unusual. So right now, the point is that Platinum is being affected by the sell-off in growth stocks, which is pretty much across the board. People are dumping high-quality names along with lower-quality tech as well. But remember that Platinum is a very diversified fund of funds run by the best managers in Canada. It's a top-notch product. It's a single solution ticket, and it's an extremely good fund. So at some point, when growth comes back in favor, Platinum will outperform in a big way. Growth will outperform value, and Platinum will take advantage of that phenomenon. So the point is we are very confident about Platinum's long-term prospects, and we are using dips to add to positions. So rest assured that this fund is going to be around for a very long time, and over time it will do extremely well for your portfolios. Just a quick word on our Steadfast Income Fund. So Luft Financial and three other teams at IA, we put this fund together last June. It's actively managed by top fixed income managers like PIMCO, PHNN, BMO, IA Clarendon. It did very well again on a relative basis in the first half with a return of minus 8.9%. And that outperformed a passive ETF like ZAG by 340 basis points, which is a big margin of outperformance. Steadfast owns about 40% Canadian bonds, 40% foreign bonds, plus other funds like a floating rate note fund and a corporate credit fund. It has a yield of more than 4% and a duration of 5.3 years. So that's what you want when rates are rising. You want medium duration and you want as high as yield as possible. And at the same time, the bonds in this portfolio are all top quality, AA or A rated at least. So it's a very good fixed income fund. So that's it about what's happened so far. Let's turn now to the economic outlook. There's very little doubt that the economic outlook worsened remarkably in the first half of the year, especially in Q2. Now, I'll give an example of how dramatically the situation has changed over the past year. A year ago, the Bank of Canada was not expected to raise rates until the second half of 2022. And a year ago, the US Federal Reserve was only expected to raise rates twice by the end of 2023. You look at the situation now. The Bank of Canada has already raised rates 4 times. And the most recent hike was a 100 basis point jump, which is huge. And that came after 2 50 basis point hikes in April and June. You can see that on the chart on the left. So even now, the bank's benchmark rate, the overnight rate as it's called, is only at about 2.5%, and inflation is close to 8%. So there's a big gap there. The Fed is also raising rates at a rapid pace. The point is, why are the central banks acting so aggressively? Because they lost a full year in 2021 based on the belief that inflation was transitory, that it wasn't here to stay, and that it would just go away when things got back to normal. That's not been the case. And it's like I mentioned, it's been made worse by the Russian invasion of Ukraine. And why is that? It's because those two nations are very big energy and commodity producers. And, when supply has been disrupted from there, so it's having a ripple effect across the global economy. As a result, inflation is now at a 4-decade high of approximately 8% in both Canada and the US. And if you look at the chart on the right, it shows you the inversion of the US yield curve. That's a fancy term. What it just means is the difference in yields between the US 2-year US Treasury and the 10-year US Treasury. Now, in normal times, you should get a lower yield on the 2-year than on the 10-year. But when things are looking a little bit distressed, that equation flips and you've got 2-year yields higher than 10-year yields. So anyway, it's supposed to be a really accurate predictor of recession. And that's what the chart on the right shows. And traders are so convinced about this that they are already looking past the rate hike cycle and factoring in rate cuts in the middle of 2023. So that's about a year from now. It's a very, very quick turnaround in sentiment from the last 6 months that we've seen. So everyone's freaking out about inflation and recession. And yet, this might be a really great time to buy bonds. Why? I've listed 5 reasons. First of all, current yields are quite attractive. You're getting bonds with a yield of 4% or higher. You're getting GICs with yields of 3.5, 4%, something like that. That's point number one. Second point, as I mentioned earlier, if central banks start cutting rates next year because there's an economic slowdown, bonds will appreciate in price. That's just the way it works. When interest rates go up, bond prices come down. And when interest rates go down, bond prices go up. Point number three, if inflation is peaking, as some economists think, central banks will be less aggressive in raising rates and bonds will rally as a result. You can see this in the last few days. There was a great deal of expectation that the Fed would raise rates by 100 basis points towards the end of the month at its next FOMC meeting. But over the past 3 or 4 days, there have been some words coming out of the Fed, some comforting words which suggest that they might be happy with 75 basis points. And just that little change has enabled markets to go up quite a bit. So investors are extremely sensitive to how the interest rate landscape is changing. Point number 4, bonds are a great portfolio diversifier. Every time bonds endure a sell-off like they did in the first half, which was a historic sell-off, it's hardly ever happened. When that happens, we get experts calling for the death of the classic 60-40 portfolio, which is 60% equities, 40% bonds. I don't believe it. It's far from it. That portfolio has stood the test of time, and it's even if you have inflation on the upswing for the next few years and you have interest rates going up for the next few years, bonds still have a place in your portfolio. And why is that? Point number 5. Bonds are a great source of cash when we rebalance during an equity pullback. In most cases, when you have a big correction, like in March 2020, bonds rally because there's a flight to safety aspect. People want a safe haven. And at the same time, you also have expectations that central banks will cut rates to boost the economy. So the combination of those two factors makes bonds go up a lot in price, outperform stocks quite a lot when you have a big market correction. And so they become a really great source of cash. You sell a few bonds and you add 2 equities that are down. Works all the time. Here's my outlook for the second half of 2022. The first point is recession coming or is it already here? Now, technically, a recession is defined as 2 quarters of negative GDP growth. If you look at the US, the economy contracted by 1.6% in the first quarter, and it's quite possible it contracted in Q2 as well. The Canadian economy also shrank a little bit in May. So we might very well be in a technical recession even now. And yet, there are quite a number of mitigating factors. So the first thing is that in a recession, a distinguishing factor is the specter of job losses. Lots of people lose job losses in a recession. But at the current time, that's not the case in North America. Both Canada and the US have an extreme labor shortage and a historic labor shortage. Canada's jobless rate last month fell to a record low of 4.9%. So we're not seeing job losses yet. There's still some time away. The second point is that consumer spending is still very robust. People have had enough of pandemic restrictions for 2 years. So if you go out, malls are full, airports are full, people are on vacation. It's quite challenging to take a vacation at this time given the situation at the airports, but still people are still going out. Consumer spending is still very robust. Another point is that it appears that COVID, people are already coming to grips with COVID. I know we have new variants out there and that pandemic is still a threat on the horizon. But if and when COVID fades, 2 of the main things that have been affecting global markets, which is supply chain issues and labor shortages, they ease up. And that will put downward pressure on inflation. Another point, What if the Russia-Ukraine conflict gets resolved in the next few months? It would be a tremendous boost to markets. It would take a big source of geopolitical uncertainty away, and it would take a big factor that's been pushing up inflation away as well. So if all these conditions occur, inflation could peak and central banks will slow down the pace of tightening, and that could cause a relief rally in equities, just like we are seeing right now. I'm not sure if this rally will continue, but it's comforting to see that we are trying to set some kind of bottom for the markets. Two other points. Bear in mind that in a typical recession, the markets go down by about 40%. Now, the S&P was already down 21% at the end of last month. The Nasdaq was down 30%. So a lot of the damage has already been done. People are discounting a worst-case scenario, which means that further downside might be limited, but conversely, over the next 3 to 5 years, there could be a lot of upside. And finally, valuations are also much better. In fact, they've shrunk at a record pace. So last year, for example, the S&P 500 was trading at about 24 times earnings. Right now, it's trading at about 17 times earnings. That's a very big downward shift in valuations, and it's really market supportive. Now, all that said, I do believe that earnings estimates from analysts are still too optimistic and could be revised lower. So some strategists think that the markets could rally 30% over the next 6 to 12 months. I don't think we'll get close to that, but we'd be happy with a 15 to 20% rebound from here. My last slide. What's been a strategy and what's a strategy going forward? We are sticking to the middle of the road. We are not taking a big bet one way or the other, not getting too defensive, not getting too aggressive. The approach that has worked for us is a balanced approach, and that's what we're sticking to. We may increase our US stock holdings because we're seeing plenty of excellent companies on sale. And with the US portfolio, if things fall apart, you'll always see the Canadian dollar sliding in that case, and that Canadian weakness provides a downside cushion to us in terms of dollar holdings. And US stocks are a great way to diversify. We've got very limited Canadian choices in sectors like healthcare, consumer staples, tech. So, we need more US stocks. Currently, we are not very far away from our rebalance targets. Like I mentioned in our report, we rebalance when the markets move about 7.5% away from our last rebalance level. And currently, our targets are at 18,200 for the TSX and 3,635 for the S&P 500. So currently, we're looking at two scenarios. The first one is that recession risks intensify, things get really bad. Yeah, sure. We have to be prepared for that. In this case, what we intend to do is increase the defensive tilt in your portfolios by trimming growth securities and by buying bonds and dividend payers. On the other hand, the second scenario, one that's more optimistic, is what if recession risks recede? Or what if you're already in a recession and over the next few months we're coming out of it? In this case, our intention is to take money from our alternative sleeve, which is a hedge fund, dynamic alpha hedge fund, and maybe the Antrim mortgage fund. And we'd use those funds to top up our allocation to growth. So we'd take a little bit from the alt sleeve and top up a growth allocation. And that's typically how it works in a rebalance. Now, I'm going to conclude with, what you can do at such times when markets are going down. It's stressful, your portfolio is going down. So I've got a couple of suggestions for you. The first thing is, enjoy the summer. Don't focus too much on the negative news because this tends to get amplified when markets are volatile. Remember that when the media is full of negative news, it may signal a potential turning point in the markets. That's been my experience for many years, and it's true in most respects. Secondly, if you feel like making big withdrawals from your portfolios, resist that urge unless you really need the money. So this is a time when you should have as much of your money working for you as possible, because the best market returns often come after a big market pullback. And the third thing, and I think Robert uses this kind of example all the time, think of a portfolio as a rental property that is mortgage free, and that will give you at least 3% to 4% in annual income plus growth potential. And guess what? No property taxes, no startup fees, no maintenance expenses. So your portfolio is a very high quality, and they're going to ride out this storm. It's going to be it's not going to be easy, but we'll get there. And over the next 3 to 5 years, if you have a little bit of patience and you hold on, I think you can be assured of really good returns. I would be very happy to take any questions after Aaron's presentation. And thank you again for your time. And over to Aaron.
Thank you, Elvis. So Robert and Elvis spent a lot of time, setting up the benchmark so you can understand how your portfolios are doing relative to a benchmark, how you can compare how your performance is to the rest of the world. And Elvis spent a lot of time going into the more technical specifics of what's going on with the market, the reasons behind the market dropping, and what we need to see things turn around. What I really want to spend some time is understanding volatility, the price fluctuation of your portfolios from the highs to the lows, but how that really impacts on how you feel emotionally about that, as well as how you behave and react to those. So what we call behavioral finance. We can't predict, nobody can predict exactly when the markets will rise or fall, day to day, month to month, year to year. But what we can control is how we react to those market events, and how, what we should be doing and how we can focus on the long term. So I could easily just sit here and tell you, don't worry about it, focus on the long term, things will get better. But rather than just tell you that, I want to show you as well as what's happened in the past and what you should be doing during these markets. So we have a lot of pictures and slides. I'm really going to explain them. You don't need to kind of go into all these numbers. They're quite busy, but just getting the bigger picture ideas, and that's what I want to focus on. What we don't want to get caught up is the emotional roller coaster of investing. If we look over a 20-year period, this is the Canadian TSX, we can see we've had big periods of drops from 25 to 50%, 37%, but we also have long periods of up. So we get the long downs, the long ups, the big downs, the big ups, and it goes on and on and on. And this cycle will continue and continue and continue over the next 5, 10, 15, 20, 30, 100 years as well. So it's not unusual in the past, and it's not going to be any different going forward. So what we really want to kind of do is find ways that we can not focus on the short term and worry about the highs and the lows, and focus on the long term. And I get that that's easier said than done sometimes, even for professionals like ourselves, that when you get your monthly statements or you're looking at the news or the headlines, it feels quite different. So hopefully I can provide some comfort by showing you better ways to think about it, as well as how it's performed in the past. So the first thing we want to look at is going market timing. So how can we time the market? Now the truth is nobody can time the market. And the best thing you can do through these periods of ups and downs is staying invested. What this slide shows you is that staying invested the whole time through the goods and the bads versus trying to time the market. Now, if you were trying to time the market and you missed just the 10 best days, you would have your return would almost be half as much as what it would have been if you stayed in the market and received all the bad days and all the good days. Now, if you go down to receiving or missing the top 20 days, your return is only 2% versus 8%. So quite a significant drop. Now, if you start missing the top 30 days or 40 days, you're getting into territory where you've been losing money. So because we can't predict when the best 40 days are, or the best 30 days or best 10 days are, and we can't predict when the worst 10 days or 30 days or 40 days are, the best strategy for the long term is to always stay invested, because market timing is just a guessing game. And if anybody tells you otherwise, they're lying to you, they're lying to themselves, or probably both. So although there has been a lot of reasons to not be invested over the last 20 years, 30 years, 50 years, there's always one good reason to stay invested. And that's to focus on the long term and the returns over the longer term. Now, over the short term, you look at this chart and it's giving you all the reasons of the European debt crisis or COVID, supply chain issues, the war in Iraq, the big financial crisis in 2008 where the markets dropped. But even when you factor these all in, you can continuously see the chart moving, steady and slowly kind of up to the right. And that's what you want to look for in the long term. Because again, we can't time it. You just need to stay invested. Now, when we focus on the long term, to provide some comfort to that, is you want to look over rolling periods of time. Now, this is an example of the TSX. Now, if you look at any rolling period of time over a 10-year period, you can be confident in knowing that nobody has lost money in the TSX for this example specifically over a 10-year rolling period. This shows you month over month. Now, as well, it shows you that there's no pattern to this. There's no, okay, I go up for a month or 3 months, I go down for 1 month. I go up for 3 months, I go down for 1 month. It's sporadic and it's compounded, meaning that we'll have a lot of up months in a row and then we'll have a lot of down months in a row. So again, going back to that market timing where we can't time it. But knowing the comfort and knowing that, for a longer period of time, the returns are greater and your probability of making money versus losing money gets higher and higher as the longer the time goes out. As we like to say, it's not about timing the market, it's about time in the market. And the longer you can be in the market, the higher your chance of success. And not only that, the good times seem to outweigh the bad times, and quite significantly. So when we look at, again, just using the TSX as an example, and I can as well provide some numbers and examples of the S&P 500, but the good times really outweigh the bad times. So the average length of a down market, so the negative, what we call a bear market, the average length of going back to 1956 is about 8.2 months. And the average drop during that time is about just under 25%, 24.5%. Now you compare that to the average up market, which we would call the bull market, is 41.6 months on the upside. So 5 times as long as the down. And the return, the gains on the upside are over 100% during that period of time, versus obviously the drops are going to be negative. So it's quite a significant difference of the amount of time up versus the amount of time difference. However, when we focus on our behavioral finance and the emotional side, is we feel the down markets way more than we feel the up markets. We feel worse losing $1 than making as good as we feel making $2. And that's normal across the board for everybody. That's just humans. That's how we feel and that's how we deal with it. So we really need to take that part out and kind of look at the numbers and focus on the longer term. Now, for the S&P 500, if we want to use these numbers and kind of look at comparing that to the US market, it's similar. So the average bull market, so the up market, is about 162%. So quite a bit more on the upside in terms of return, with a duration of 51 months. So a little bit longer as well. And the average decline since 1926 is about a 41% decline. So a little higher ups, a little lower lows over a 20-month period. But again, the goods have far outweighed the bads. To give a specific example, we want to compare, just look at COVID versus the financial crisis. So COVID was a really quick down and up. The down days were, well, we refer to them as days because it was so short. It was only about 33 days from the time the market peaked to the bottom, so about a month. And the recovery was about 163 days. Now, if you want to compare that to the financial crisis, it was back in 2007 when it peaked down through 2008, 2009. The drawdown lasted about 17 months. And the drop was, way more significant at about 57%. And the recovery time, because the more significant drop, was also much longer at about 65 months. Now, these are two kind of extreme cases where COVID was really, really quick, and the financial crisis was, a steep drop, and a longer recovery. So both had steep drops, but a longer recovery versus a short recovery. Now the average recovery, as I was giving you before, is the mean is much more in between. So how often do these happen? And this is what people really tend to forget, is that it's not uncommon for corrections or drops in the market to occur. So on average, we've got, looking at 4 different data points of a 5% drop in the market versus a 10% drop, 15% and 20% drop. So a 5% drop in the market happens, 3.5 times per year. So 3 to 4 times, that's once every 3 or 4 months per year. Now, you don't always notice these. They can happen quick. They can happen inter-month, and maybe you don't even notice it on your statements. Now, you compare that to a 10% drop. Now, this is happening on average about once a year. A 15% drop in the market is now happening about 0.5 times per year, so once every 2 years. And when we get into a more serious correction of 20% or more, that's happening about once every 3 years. And we've been through these. We were through it in COVID back in 2020. We had a significant drop in 2018, at the end of 2018, and again now, obviously, in 2022. So we've actually had 3 of them in the last 4 years, which is more significant, but we didn't have any for a little ways before that. So again, we're getting back to that averages. And knowing that, these happen regularly and the end result is always the same, where it takes time to recover, but we do come out of it and continue on upward. The good outweighs the bad. So that's why we need to always focus on the long term, and knowing that when these events do happen, we need to be proactive. We need to stay invested. And again, we need to focus on the long term. Yet knowing all this and getting into the behavioral finance, why do some investors still want to buy high and sell low? We all know, we want to buy low, sell high, but it's in fact the exact opposite what happens in real life. And we can track this and chart this, because we can see that when the market's going up, we can see that the fund flows, meaning the money coming into the market doing the buying, is positive. Money's going into the market as the market's going high and is peaking. And when the market's dropping down and is going down in negative territory, we can see money coming out of the market. We can see sales being happening and pulling money out of the market. So doing the exact opposite of what you should be doing now. Now, what we do for our clients on behalf of you is we always give you the options. You can either do nothing, recommendations, do nothing, stay invested, or 2, put in more, buy more. And if you're doing, if you don't have more money to put in and buy more, that's fine, because we will do it for you by, as Elvis was talking about, rebalancing internally, taking profits from certain parts of the portfolio and allocating them to buying things that are on sale. So although we know what to do, our brain is telling us what we should be doing, our emotional side often takes over and tries to tell us to do the opposite. And that's kind of always the battle we're fighting against. And that's why hopefully showing you some of these stats and charts and reassurance of going, over these time periods, we've gone up, we've come down, we always come out of it. So if I provide some hope, as well as, a little bit of, on the positive side looking out, is that, as I mentioned, once every, 3 years, we have those 20% declines. We look at 15% declines, 10 and 5% declines. What we're showing here is intra-year declines, all the red dots. So we can see that in, pick a year, throw it back to 1980, we've had declines of, in the 80s, down 34% intra-year. They were down 34%, but still finished the year off positive at 2%. During COVID, we were down at some point, not we, but the markets were down 34% and finished the year off 16%. And you go back to the financial crisis and other years, you can see the lows and where the markets actually finished off. So if we were to compare it and look at our year currently, we're halfway through the year. Hopefully in 6 or 12 months, we are seeing things recover in terms of inflation and rates and the war and whatnot, and we can have that bounce. So we can actually look at the intra-year low decline versus how it actually finishes up. But as well as just providing some, hopefully better ways to look at it, is when we look at the consumer confidence in the stock market, it's actually never been lower. Now, typically when we look in the past, when that is the case, the rolling 12-month return from where we are today, or we're looking at a year from now, has typically been very, very good. Now, the past is is not predicting what the future will be, but it's a good data points to look at and provide some of that reassurance. So when we're looking at the drops in the 80s or 90s, or even in 2008 or 2020, all these points at the bottom, we can also see that the following 12-month return of the S&P, this is the S&P 500, is quite significant. The numbers are quite big. I don't want to get into those specific numbers, but they're because they look really, really good. But when things are really, really bad, in terms of sentiment, that's usually we're starting to turn and starting to kind of, hit that bottom and starting to hopefully see a bit of correction. So as the Oracle of Omaha, Warren Buffett, like to say, when, be fearful when others are greedy, and greedy when others are fearful. This is what that chart kind of shows in terms of sentiment. When it's high, the rolling 12-month period is not nearly as good. When it's really, really low, we tend to see good returns. Now, the end of the day, we can say that, we can look at that. We can also go, well, we're down 10%, the market's down 20%, but how do we really feel? And how do that really play into a longer term, into the longer term? So what we want to look at is going over 1 year, 5 year, 10 year, 20-year period of investing. What are your probabilities of earning a positive return? As we've always said, if you need money in the short term, over the next 6 months, 12 months, even up to 3 years, you're probably better off being more conservative, being in cash, something guaranteed. Because over a 1 year number, anything can happen. And that's the graph on the furthest on the left there. Over 1 year in a balanced type portfolio, we want to focus on the gray lines, is that the range of that has been from -15 up to positive 33% over a 1 year rolling number, back to 1950. Now, if we extend that out to a 5 year period, where we like to say focusing on the long term, at least 5 years in terms of your investing, a balanced 50-50 portfolio has never been negative. So if we want to look out 5 years from now, the chance of being negative from today, I would say are, you can never say zero, but are extremely, extremely low. And it has never been negative in the past. And that's going from a peak market. We are nowhere near our peak. We are quite far off the peak, off the bottom. So the chance of being negative in 5 years from now, I'd say very, very low, even when we're looking out 3 years, the probability. Because even over a 3 year period, looking back over history, a small percentage of the time that you've been negative, less than 15%. So in terms of kind of looking out to the future, that's where we always say we want to focus on that 5 years, and the probability of making money over the next 5 years is very, very good. And, although some people on this call may be retired or retiring in a day from now or a year from now, and you're saying, well, my long-term is no longer as long as it once was, it's still most likely, I would say, over 5 years. Although you're retiring in a day from now or a year from now, you're not going to spend every dollar you had in the next month or 12 months or next day after you retire. It's still to last for the longer term. And we are going to go through these cycles over and over again. And that's why we just want to kind of keep telling this story, have to focus on the long term, but not just tell you, to show you why and show these numbers and how things perform over time. So with that, we'll kind of wind it up. I'll bring everybody back and we'll look at some of the questions we might have on the chat and anything else we need to address before, we can let people get on with their day. And thank you very much.
So now would be the time if anybody has any questions that we could ask in the chat. I see there was a question from Sandra Corbett. I'm just looking at the first one there. How are bonds taxed? I'll take that one. I mean, bonds pay income, and they can also fluctuate in value to make a capital gain. They can go up or they can have a capital loss. Just like any other investment, if you hold that security in a registered environment, so an RSP or a tax-free savings account, obviously there's no tax on the RSP until the money is removed from the plan, and there's no tax on the TFSA at all. So generally what we'll try to do is try to hold a lot of that fixed income, if possible, in a registered plan. If you do hold it outside of a registered plan in a non-registered account, the income that you receive, you'll get a slip for, and it'll be taxed as interest income at the highest marginal rates, and any capital gains and losses will be taxed as capital gains and losses. So it's best to hold the fixed income, if we can, in a registered environment.
You had a few questions pop up while you were answering that one, Robert.
Oh, okay. Yeah. Wow, yeah, that's good. Maybe one of you, somebody else wants to take Bonita Murdoch's. We'll start there because the other ones have been answered.
Aaron, do you want to take that one? You kind of talked about the...
I think it's to do with some of Elvis's comments, which I haven't caught up in there, about the baby boomer.
Yeah,
Go ahead.
I can take that.
Sure.
So essentially, Bonita, one of the reasons why the stock market did so well over the last 30 years was because of this big, enormous pool of cash from the baby boomers going into the stock market. And those, of course, are people who were born in the 50s and early 60s, like me. But now what's happening is that as people transition to retirement, they want something that's a little bit safer than stocks. So I think that, given how attractive yields are, how much they've risen over the past 6 months, you'll probably see more money going to fixed income to capture those high yields. And when there's so much demand for bonds, it means that yields will come down a little bit. So if that happens, conversely, it's actually good for stocks because stocks need a low yield environment to do well. I hope that answers the question.
Perfect. There was a question again from Sandra saying or asking, when's a good time to go from a balanced pension portfolio to a dividend portfolio? I can take that one. I mean, reality, both of them are diversified. The dividend portfolio is better suited for accounts where there's no tax sheltering opportunities, because now we're investing in a diversified manner, but the common thread amongst the investments, or the majority of them, is how we're distributing the income. And that's coming in the form of an eligible Canadian dividend, which generally has all the tax advantages attached to them. If you have money in an RSP or a locked-in RSP, you can earn interest or capital gains or dividend income all the same, and none of it is taxed until you withdraw the money from the account itself. Hopefully that helped.
Laura, I'll take Lori Holland's, or do you want to take Lori's, Aaron?
No, go ahead.
So this is a really good question. Perhaps we should have addressed it, but the really simplistic answer is there's really 3 withdrawal rates you can look at on your portfolio. And the easiest way to calculate it is looking at a specific percentage of the assets that you have for the longer term. So let's say you have $100,000 for your retirement, and that's it. If you're in a balanced portfolio, we're not talking about cash, but if you're in a balanced portfolio or better, 3 percentage withdrawal rates to remember would be 3%, 4%, or 5%. 5%, so if you're taking $5,000 for every $100,000 you have, as a withdrawal rate from this point will be capital depletion. In other words, that $100,000 will be expected to be gone by the time you're gone, right? So we might say a 60-year-old retiree, that money would last 25 years to say age 85. That's 5% withdrawal rate. A 4% withdrawal rate would tend to last longer, okay, up to 30 years. So if you have a higher expectation for your lifespan, or you don't want as much depletion as your capital, be a 4% withdrawal rate. 3% will generally maintain your capital, 3% withdrawal rate indexed to inflation. So what you do is you say, well, if you're taking out $7,000 a year from a $100,000 portfolio, you're going to have a very rapid a descent in the value of your capital throughout your retirement. So one way to answer your question is to take how much you're taking out, divide it by how much is in your portfolio right now, and then see if you need to adjust your withdrawal rate. So if that percentage is higher than 5%, at this point, you might want to decrease it until such time as the markets come back, or utilize cash that you have on hand.
Elvis, there's a question about the Fed raising the rate
Yeah.
by 1% to follow Canada, if you want to address that.
Yeah, sure. So Kim, the thing is that I think it was last Monday, there was sudden expectation that the Fed would raise rates by 100 basis points. This was deliberately leaked to, I think, the Wall Street Journal, and the market freaked because they were expecting 50 to 75 basis point hike at best. The current consensus now, there have been a couple of Fed officials who came out and they do something called job owning, which is trying to talk expectations down, right? And what they've said is that they've hinted that they may not go more than 75 basis points. So the market's reacting very positively to that. So to answer your question, if the Fed does raise by 1% on July 26th or 27th, it would be a slight negative for the markets. But bear in mind that you've got a lot of economic data coming out in the next couple of weeks. The market's going to focus on that to see, what's the extent of weakness in the economy. That's going to be a very big thing. That'll probably dictate the Fed's decision as well. And if the Fed does, in the best case scenario, the Fed raises 75 basis points, and they come out with comforting language saying that, guys, things are not really bad. Inflation might get under control. We probably don't have to raise rates so aggressively. If that happens, the market will continue to rally. So in other words, it's a very fluid situation. It's hard to say where, but the odds are that the Fed might come out and try its best not to freak out the market even more than it is right now.
We missed one from Evelyn Rockcliffe. I have cash to invest. What to buy? So this goes back. I think we all kind of touched on it a little bit, Evelyn. First rule, when do you need the money back? So if somebody can honestly say, I've got $1, I have no desire or need for the income or the growth on that dollar or all of the capital for a 3-year period of time, it's not savings, it is truly an investment, then it becomes an investment. You move it to your investment bucket from cash. Now, the next thing, what to buy, obviously depends on somebody's personal tolerance, that emotional capacity, as Aaron explained, for risk. And risk is not losing all your money. It's the variability you can handle. So we offer 3 distinctive risk buckets. All in, which would be our growth bucket. Balanced growth would be 60% of the volatility, and more conservative or balanced, which would be 40. So the first decision is this truly long-term money? If so, I can invest it. If I'm concerned about variability, then I go with a lower allocation to equities. The simple way to answer it would be if you put that dollar away, you didn't look at your statements for a year, and you came back 1 year later and you opened up your statement. What would be the worst you could expect to see that dollar become before you changed your strategy? In other words, what's the biggest drop you could handle? And sometimes I'll hear clients say, I couldn't handle any drop. I want the dollar to be $1 a year from now. I said, great, then you should open up an account at Tangerine. But I'm only going to make 2.5%. Yes, but you'll have no variability. We have a very high odds of losing money on a monthly basis. So in a month to month, it's 50-50. Your portfolio might be up or down. Year over year, 75% chance of it being positive, 25% chance it's going to be negative. But once we get to any 3-year period, we can say with a lot more certainty historically that even our balanced portfolio, 90% of the time over any rolling 3 years will be positive. So it comes down to your tolerance for variability. When things are really bad, like right now, I have put in a significant amount of personal capital to our Platinum Growth Fund. Okay, I am the largest single shareholder of that fund as the portfolio manager and out of our clients. I have put a significant amount of money into our models. So I always tell people, ask your advisor, your team, what are they doing with their money? If they're doing something totally different, then you shouldn't be doing that unless they're taking more equity risk than you are. No more questions. Maybe everybody's off. Oh no, we still have 47 people on the call. Okay. Anything else? Anybody else have any other good questions for us?
That looks about it.
Okay.
Well, the good news is they all have our numbers, so that works.
You know where to find us, right?
Yeah.
Great point, John. Yeah, if you've got any questions, reach out to any of us, any member of the team. Great time to do some reviews. If you haven't had your portfolio and your financial plan reviewed over the last little while, make sure you contact your advisor and book a consultation and go over your financial plan and your portfolio, make sure it still does match your goals. Especially, we've got a bit of a lag during COVID, so we'll be reaching out to people, and hopefully this was helpful.
One more question just popped up.
Oh, of course.
I know. So you'll have to give that spiel again in about 5 minutes here. But Karen, how liquid are tax-free savings accounts? They're very liquid in that you can have access to the money whenever you'd like. They're better served if you can leave the money in there longer, though. They're not a good savings account, good investment account for the long-term growth. That's when they really realize their value. But there's nothing preventing you from accessing capital in your tax-free savings account.
Hey, thanks, John.
No worries. Do you want to say goodbye again, Robert?
I guess we'll all say goodbye. Thank you very much, everyone, for attending. Please give us feedback if you can. We'll send. Aaron, are we going to send a survey? Does this come with a survey that you were sending?
It was before. It was with registration.
Oh, it was before. Okay.
Yeah.
Okay.
Yeah, we'll keep doing them. All kinds of different topics, and thank you for coming.